Hi, everybody, and welcome to tonight's Zoom, where we're going to address the major topic right now, which is interest rates. And tonight, I am here with Jason Thomas of JMJ Financial. He's an amazing lender in the area. And both of us want to just cover some different topics that are really relevant and timely in today's market that we're seeing come across from a lot of buyers, a lot of prospective buyers, as well as just letting sellers and homeowners kind of know what's going on out there as the market is shifting. So, hey, Jason.
Hey, Holly. How's it going, everyone? As she mentioned, I'm with JMJ Financial. I'm a mortgage advisor. And yeah, we're here this evening to go over some of the challenges that buyers are experiencing in this market right now.
Yeah, so we're having a little bit of a technical issue. Otherwise, you would see Jason's gorgeous face on the screen. But if you're just listening by audio, it doesn't matter anyway. And just a quick intro for me, I'm Holly McDonald. I am a realtor. I'm based in the Costa Mesa, Newport, Huntington area. I cover all of Orange County and a little bit outside of that. And I am with Compass, and just, we're seeing a lot in the market right now that is different even than it was a couple of months ago. So it's really good to be up to speed on the market because, as it changes, you need to adapt and know what your leverage is and what you should expect. So we just want to cover the interest rates tonight, and we're happy to answer any other questions you might have. But interest rates are the talk of the town pretty much everywhere throughout the nation right now. So I think it's really important that we address how that impacts buyers, sellers, anybody. So Jason, I know we were chatting a little bit earlier, and one of the biggest things out there, of course, is the rates are going up, and they've gone up a lot very quickly. So what are you seeing as a major hurdle for a lot of buyers to kind of wrap their heads around, and what sort of advice do you have for them right now?
Yeah, biggest issue are, buyers that, if they're not talking with their loan officer, at least on a weekly basis at this point, they should be. And on the flip side of that, their lenders should be reaching out to them as well with the changes in the market. We're seeing a lot of buyers backing out or having lender issues, due to the loan. I'm hearing that with a lot of the agents that I work with on the listing side. In fact, just received a phone call about 2 more earlier this evening. So that's the biggest challenge, is just, the rates have gone up, and, they can't afford or don't want to pay, X amount of dollars a month for a mortgage. So, there are definitely, a couple options that we can discuss tonight. And Holly, I know you're going to bring up a couple scenarios as well, based on what you're receiving feedback from with your buyers. But yeah, there's definitely some options for them to get a little bit lower of a rate and make that payment more affordable.
Yeah, so I know the rates are changing daily. Where are we at today overall, interest rate wise?
Today, your average interest rate that a lender is going to be quoting you is about 5.875 to 6%. Okay. That's going to be on a 30-year fixed mortgage.
Okay, so these are rates that we haven't seen in a few years. So they are higher than if you were looking earlier this year. They've gone up a lot. So as far as affordability goes, what are you seeing, let's say on like approximately $1 million purchase price, with the rates having gone up, 2 to 3% over the last few months? How is that impacting the payments for people in our area when you factor in property taxes, the current level of the pricing? About how much is that impacting their pocketbook each month?
So basically, for every 1% increase in interest rate, it's impacting purchasing power by about $50,000. So if we've gone from, let's say, 3% to 6%, that's about 150. So if somebody was, looking at a home for, $1,150,000 6 months ago, more or less, it's about the same as $1 million today. That's not factoring in, slightly lower property taxes, of course, but it's pretty close as far as what principal interest is going to look like.
Okay. And I think from a real estate perspective side, I think it's also important just to realize that earlier this year, if you were looking at a house for, $1,150,000, there was a very good likelihood it was going to go for much higher than that. It might have gone for 1.3. Even though their interest rate would have been lower then, the total price would have probably been significantly higher because we had lower inventory and more buyers in the market because of the low interest rates. Whereas today, it is possible, there are more and more listings. I'm seeing it in Costa Mesa because I watch that market, incredibly closely. But there are more homes on the market that are listing right under $1 million, mostly just to generate interest, because a few months ago you couldn't find anything under $1 million, and if you did, it surely sold for higher, much higher. But now there's a handful of properties that are right around that $1 million mark, and they're not necessarily getting bid up extremely high. In fact, some of them are sitting a little bit, which ultimately gives buyers a little bit more opportunity and leverage in the market, just knowing they have more options. So even though that rate might be a bit higher than it was, you have to take into consideration that you have less competition among other buyers, and your purchase price is almost undoubtedly going to be much lower, considering where it could have gone a few months back.
Yeah, you bring up a good point there. When inventory was, very anemic, extremely low at the beginning of this year, and it's still, low historically, but it's definitely increasing daily. Someone that was pre-approved for 1.15, if they wanted to have any sort of chance of getting their offer accepted, they were probably offering on a $1 million home. So fast forward to today, if now they're looking at $1 million, in order to keep the payment roughly the same, well, now they have a chance, to get that property at $1 million and potentially negotiate with the seller even further, in order to help out maybe with their interest rate as well.
And I know earlier we were chatting just amongst ourselves about different options that buyers can look at. If you are a buyer who's all about the interest rate, and I know you're out there because Jason and I have both worked with you, I know it can be challenging to wrap your head around a higher interest rate. And, you might feel like you missed the boat. And you know what, for right now, you did. That 2.5% rate is not there, and who knows when it will be again. But there are different options, and I think Jason can speak to this as a lender, about different ways to look at the interest rate and different ways to minimize the interest rate that are creative and can give you a little bit more comfort in this market. So Jason, do you want to talk about some of those options we talked about?
Yeah, so a couple options, especially if you're looking at conventional financing. They've brought back buy down loans. So as an example, there's a 2-1 buy down, and the way that works, to keep it as simple as possible, is, let's say the interest rate, you're qualified at a 6% interest rate today. The seller, or you could receive it, as a credit, from the lender as well, but predominantly it's the seller that's giving the concession. They're going to have some of their proceeds deposited into, let's call it like an escrow or buy down. And your interest rate, the 2 portion of the 2-1, is for the first year, and it drops your interest rate by 2%. So it goes from 6 to 4% for the first year. And then the 1 portion of the 2-1 is for year 2, your interest rate would be 5%. Years 3 through 30 would be 6%, assuming you're still on that same loan and you haven't refinanced or sold your property. And the difference in interest over the course of those 2 years is what the seller is giving as a concession. And basically, the interest is still being paid, for 6%, to the lender or who's servicing the loan. But the buyer is not responsible for all of it. The seller is kind of bridging the gap to help the buyer, get into the home. It's really good too for buyers who they're going to have their income increasing over the next couple of years. Or, as Holly mentioned, they're just hyper focused on interest rate right now, because I know it is a big deal. And odds are they're probably going to be able to refinance out of that loan. They still, again, do need to qualify at 6% interest rates. So you do have to be able to afford that, but you are getting a break for the first 2 years. And that's something, again, that the seller, would be financing through their proceeds. And again, it goes into an escrow account. We're starting to see a little bit of a shift in the market. It is cooling a little bit. This was definitely not an option 6 months ago because it was 100% seller's market. But as properties sit on the market for 2, 3, 4 weeks, sellers are going to be, willing to explore this option to avoid a price reduction.
So how does that work when you're putting an offer together? Like for me, how would I explain that to my clients and put that into an offer?
Yeah, so you would explain it, if you have a seller that is panicking, they have their home listed for, let's say, $1 million, and they want to reduce the price by $50,000, let's say. But they do have a buyer that, is interested in this product, and they're willing to pay $1 million for the home, if the seller is willing to help them out with the buy down. The difference in interest, we can calculate that. It'll depend on what the buyer's down payment is. But let's say it's even $25,000 or $30,000 over the course of 2 years that they're saving. That the seller is basically, gifting to them to make up the difference. Well, the seller is still going to be netting an extra $20,000 or $25,000 versus dropping the sales price by $50,000 because they're only giving up approximately half that. So it's a win-win for everyone. The buyer's getting a lower interest rate to start off. The seller is getting a little bit more in their proceeds, and it's just a really good product. And I just brought that back recently, like I mentioned. Another more traditional route is just a seller giving the buyer a credit towards closing costs for them to buy down their interest rate in points. You're not going to start off with as much of, or as low of a rate as they would with the buy down, but it is fixed for the life of the loan. So, an example for that might be if interest rates are 6% today and the seller pays, let's call it 2 points on, let's call it $800,000 loan. That's $16,000, and they may go from 6% to 5.25%, and it'll save them $253 a month.
Yeah. Plus, if you're one of those people that looks at, you extrapolate the interest you'd be paying over the life of the loan, that's going to save you probably, I don't know, hundreds of thousands, definitely tens of thousands over the life of the loan. Even though most people don't keep their loan for 30 years, it's still, if you look at it that way, that's a huge savings.
It's a huge savings. And, even if rates do come back down next year, which everyone is kind of predicting is going to happen, let's say 12 months from now, well, they still saved, let's say they're saving $300 a month, times 12 months, they still saved $3,600 in mortgage interest over those 12 months. And now they're in even better interest rate for a refinance. So, it's a great situation for the buyer if the seller is willing to do that, because again, the buyer is not paying any points. So there's nothing out of pocket for them. And it helps out the seller because they're not decreasing their purchase price.
Oh yeah, and like you said, it was no mortgage insurance, right? So is that what you said?
Oh no, I was just referring to the mortgage interest.
Okay.
It just depends on the buyer's scenario. How much the seller's going to have to pay. I mean, if the buyer's putting a lot down, they're not paying as much in order to get to like a 2-point buy down scenario. But yeah, I mean, you could do that at any loan amount, really. That's a qualified loan. So if it's 5% down, you can still buy your rate down 2 points if the seller's paying for it. Totally fine.
Another program that you told me about that I think is going to be really beneficial to certain buyers out there is the, the lock lock the rate loan, or I'm sorry, I'm probably butchering that, but what lock in your rate program?
Yeah, the lock and shop product is really good for buyers that want to lock in a rate now but haven't identified a property. And you can lock it for up to 90, in some scenarios even 120 days. Generally, there's an upfront fee that can be refunded if you close the loan. So if you end up backing out completely, it's not refundable. But that way, it gives some peace of mind to buyers. If they're afraid that interest rates are going to continue going up and it's going to price them out, they do have that option as well, and it gives them some time to shop around for 60 to 90 days and then close in 30 days.
Yeah, I can see that being a huge benefit. What sort of ballpark are we talking about for the fee that you would pay up front?
I believe it's 5/8 of a point. I can double check for you real quick.
So it definitely all depends on the amount of the loan that you're projecting to get.
Yeah. So what you're qualified at, yeah, I mean, it's going to be based off of that. So generally, in our marketplace, let's assume it's going to be somewhere around, okay, here it is. So it's half a point. So let's call it anywhere from like $3,000 to $4,000.
Which for somebody that has already sold their home and is in maybe a rent back situation, or somebody whose lease is coming to an end, and we all know rentals are in short supply right now, and those are also like crazy high prices right now. That could be a really good option, especially if you're concerned about the rates continuing to rise. And we don't have a crystal ball. And I think Jason mentioned, correct me if I'm wrong, but if the rate goes down, you can adjust it, correct? Like you can lock in your rate now, but if the rate goes down later, you can still get that lower rate.
Yeah, there is a float down option. Generally, the interest rates have to improve, fairly substantially. I mean, if it only drops 1/8 of a point, you're not really going to be able to float down the rate 1/8 of a point. But if things are to improve 1/2 a point or more, then yes, you can do a float down option as well.
Okay. So a couple of things I wanted to touch on are kind of relevant to clients that I've been working with now, some questions that I know that they have about the market, and just some comments and concerns that they've had, because I'm curious your perspective as a lender, because you see things a little bit differently than I do, and obviously we all work together. So first of all, I've had a lot of buyers who have been kind of, just sitting on the fence, and their position right now is that they're just going to wait, kind of see what the market does. They feel like, all the headlines say everything is cooling off, so they want to wait and see where everything settles. And so from your perspective, I'm just curious what your thoughts are on that mindset from a prospective buyer.
Yeah, so that's one of the toughest mindsets to navigate from our end, because it's just so general. And those are the people, maybe they're paying $1,500 to $2,000 a month in rent. They don't see a massive rush to double or triple their housing expense, and they want to wait and see what's going to happen. They're not being forced out of their home or anything like that. So yeah, that one's a little tougher to navigate. But my advice to those people, if they are serious, just to make sure that they're as informed as possible. Of course, you can't fully time the market. That's impossible, just like the stock market, just like anything else. So you're never going to get in at the absolute bottom. Keep in mind, interest rates are unpredictable. So if they think the market's going to cool off, from my perspective, Southern California, it's not going to drop. Even if it were flat for a while, if rates do continue to go up, well, then their purchasing power is actually going down a little bit. Or even if values did decrease, let's say by $25,000, $30,000 per rates go up half a point, they're still paying the exact same amount for the mortgage, and they're just buying less. So it's just something to keep in perspective. Every client, with that mindset is going to have a different scenario, and you just got to get the full picture of what they're trying to do, and make sure that they're as well informed as possible. And then of course, other things for them to consider as well that we can touch on here in a minute is some of the benefits, obviously, of owning a home, such as, you know, equity and amortization, potential appreciation, even tax savings. So we can, we can always touch on that as well. I always, make sure that my clients know that that's something to consider as well, because they are going to get, especially with today's rates, a pretty hefty, tax write-off through federal taxes. So that's another thing that we can go over as well.
Yeah, and I think a lot of people this time of year, since they've, just probably filed their taxes, I often will hear people saying, yeah, my tax person said I need to, I should really buy a house because I need that write-off. So certainly that's something that, kind of price-wise and tax-wise and interest-wise, Jason could always provide insight about, depending on your particular situation. Another thing that I have had clients saying is people are complaining because, maybe back in January, they could have qualified for a $1.2 million house. And now with the rates having gone up, they're, saying like, well, the same payment would put me at about $1 million on a house with this current rise in interest rates. So, the talk is that buying power has gone down. I know you kind of just touched on that a little bit, but is there anything else that buyers should be considering? I guess this is maybe where you want to talk about tax savings and that type of advantages.
Yeah. I mean, that's going to be the benefit at this point, regardless of if purchasing power has gone down. As an example, let's just use like a $600,000 loan at today's interest rates. 12 months from now, let's say they want to wait 12 months. 12 months from now, if they would have bought today, they would have gained $8,000 in equity through amortization. And then we don't know what the potential appreciation would be because we don't know where the market will be. But let's say they bought an $800,000 home, put $200 down for the $600,000 loan, and that property goes up even 3% in the next 12 months. Now it's worth $824, and they've also gained $8,000 in amortization. So it's a net gain of $32,000 that they lost by waiting for 12 months. If they want to use the argument that, well, hopefully rates will be lower 12 months from now, that's fine, but you also just refinance in 12 months anyway and then still keep your $32,000 realized gain, 12 months from now. Yeah. So yeah, that's the thing to consider there. And then again, with the higher interest rates, depending on the loan amount, and again, I always refer everyone, someone to a CPA for tax advice, but just to keep it simple, I mean, if you compare someone's standard deduction versus if they're itemizing, and depending on if they're married or unmarried and whatnot, they could potentially be writing off $45,000 on their tax return by owning a home versus I think the standard deduction is $12,900 for single and double that for married. So either way, I mean, and depending on what tax bracket, that's where you get into with everyone. There's a lot of potential tax savings. It could be multiple thousands of dollars.
Yeah, it's a lot of things to consider. And the other thing that I'm also hearing from buyers is okay, so here's the thing. We are seeing it. It's no secret that homes are coming back on the market. Like you mentioned before, Jason, like sometimes buyers are having qualification issues. And I think some buyers are also getting cold feet, or, because there is more inventory, it's just it's just the way the market ebbs and flows. But generally summertime, you'll see the inventory start to add up because they don't sell as quickly. Plus we're just in a market where more homes are becoming available. So, I think what's happening is buyers are, seeing that the grass is greener somewhere else. And so of course that's happening. So we see homes falling out of escrow and we see major price reductions. And a lot of the price reductions I'm seeing are quite significant. And buyers are seeing that too, because they're getting the alerts from us, or they're watching Redfin and Zillow. And I think they're all kind of starting to panic a little bit because they're wondering, why are these reductions so drastic? And from my perspective, I believe some sellers have overshot the market just based on the trend from earlier this year and late last year, where you could put a house on the market and due to, you know, supply and demand, it would just get driven up so much. And then currently that's not happening. And I think sellers are watching the market and getting freaked out if their house doesn't sell right away. And so they're saying, I got to pull back. Like I wanted those multiple offers. So I need to reduce like to the max to get that frenzy. When that might be a great strategy for them, it depends on their situation, but it may not be the best strategy, because if you reduce too much, you know, the risk is, what if you don't get that effect? Like what if you reduce to the point where you still only get an offer or two and you don't get that frenzy? Because the frenzy exists when you have way more buyers that are excited than sellers. And right now we have more sellers and we have a decent amount of buyers. Like there's too much of a divide. There's not enough divide, I guess I should say, between the two. Like before it was this many buyers, this many sellers, and now it's almost even. So anyway, long story short, I see a lot of buyers seeing all of this and, you know, taking into account the headlines and thinking, this is my time to swoop in. I'm gonna get a deal. I'm gonna lowball. I'm gonna negotiate the heck out of this thing, and that sucker is gonna be mine. And I'm not seeing sellers necessarily like go for that. I have seen sellers get lowball offers, and I've seen them be upset about it, but I'm not seeing them say like, oh wow, like this is the market speaking to me. I must be so much, you know, I must be priced way too high. I'm seeing sellers say, no, I'm gonna stand my ground. Like I'm not gonna give my house away. From your point of view, since obviously you deal with the loans once the offers are accepted and you're dealing with lots of agents all over the county, are you seeing a lot of buyers actually winning right now? Like, are they really getting huge, heavy discounts, or are they still having to be competitive?
Yeah, well, I mean, we're not in a buyer's market, even though it is shifting a bit. It's still leaning towards the seller. So the buyers that I've gotten into escrow that I'm working with this year, and obviously it was really exaggerated earlier this year, but it was the ones that like, hey, I really want this house. I'm going to do whatever it takes. The ones that are looking to get a deal, they're still shopping 6 months later.
Okay. Yeah. Okay.
I have a lot of them, unfortunately, that they think they're going to get a deal. It's not really happening, and that's kind of the reason for for this call here is, the market is going to dictate what's going on, and we have to come up with the best strategy for our buyers to help them get into a home if they're serious about getting into a home. And that's where it's not, hey, I'm going to lowball this house. It's, hey, why don't I approach the seller and see if I can come in closer to or at their asking price, and see if they'll help me a little bit with my interest rate by tossing a credit my way. And we already spoke on a couple different ways to go ahead and do that. Buyers are going to have a lot more success with that because the seller is they're working with the seller's working with the buyer, and at the end of the day everyone's happy and getting more of what they're looking for, versus as a seller, if somebody's trying to lowball right now, and if it's significantly low, it's not really being entertained.
Yeah, and I think one thing I did want to address for any potential sellers that are listening, because I do a ton of videos. If you don't follow me on Instagram or Facebook, you may not be aware, but I post pretty much daily updates about the local market. And a lot of what you will see is like this many homes have sold, and the majority of them have sold for above the asking price. And so while that is true, I don't want to confuse sellers. I want them to realize that it's still a great market, but it's not as great in terms of getting a bazillion offers in a day and getting crazy overbidding situations. It's much more rare right now. And so homes need to be priced well. You need to take the offers that you get seriously. You need to not be depressed if you don't get 5 offers. You need to not be upset if they're not all crazy, like high offers, because you are going to probably get some lower or more in line with what a buyer feels the home should be going for based on their payment type of offers. So keep all of that in mind. And like Jason said, you really want to pick the buyer that is the most likely to perform. Ideally, you don't want to fall out of escrow. I mean, if it happens, it happens and we deal with it. But ideally, you want the buyer that's most likely to close and going to pay you a fair price and make it as enjoyable of a process as possible, because we're still in a market where you can really, you know, have an advantage. Because again, like, we're talking about homes not selling in a couple of weeks and people getting upset, but you know, it hasn't been that long since like pre-pandemic when a home would sit on the market, and it might sit on the market for 6 months and you had to do like 4 price reductions, and like that was just a few years ago. So I mean, it is still amazing that homes are selling quickly. But the other important thing I wanted to point out is that when I report and say that this many homes sold for above the asking price, that all sounds really good and exciting, but some of those homes are priced with a strategy of getting overbids. So, you know, the home may not be going for $200,000 above asking price because buyers were like so excited to spend $200,000, $1,000 more. It's because the house was priced below market to get that effect. So like if you price a home way low, you're probably going to get it bid up way high if it's, you know, all of the stars align. And then the other thing is, when I report those numbers, that is for homes that have just sold. So homes that have just sold were based upon offers that were made 3 to 4 or 5 weeks ago. And 3 to 4 or 5 weeks ago is actually, it's a long time in terms of what interest rates have done in that time and what the news has been putting out there. And so, like Jason said at the very beginning, if you are looking to buy a home, you need to be in touch with your lender basically weekly to know if you still qualify. But I know we're running out of time, so I just want to thank Jason for his time and thank everybody for sending their questions and participating. And, you know, we're happy to do this again and address other topics that everybody finds relevant. So Jason, thank you so much.
Yeah, thanks for having me, Holly.